How to review your stock portfolio like a pro. You see, when you are buying stocks for the first time, you invest in doing research to get quality stocks. That is only one part of the battle. The other part of the battle is you ensuring that at all times, your investment truly deserves your money. Simply put, you need to ensure that your investment in whichever stocks out there through a portfolio constitution is in healthy state. Out here, many people do put a huge chunk of time in the initial research, but they rarely invest in really understanding and ensuring that their portfolio is in good shape. That's why I'm making this video to assist you know the 10 steps you're supposed to follow for you to be able to review your stock portfolio like a pro. Watch the whole of this video for you to grasp these concepts. And by the way, in case you are new here, my name is Afagza Sifuna. I am a finance expert and qualified accountant, bringing you these amazing videos about investing and making money each and every day. In case those are kind of topics which you like, down there is a button called subscribe. Click that button and subscribe to my channel for you not to miss any of the videos which I do upload each and every day. And I will still add it. Drop a like on this video. And by the way, guys, before I forget, some of you have reached out to me asking if I provide one-to-one coaching and mentorship. I can support you at a very affordable rate. I've attached my WhatsApp number down below. Hit me up on WhatsApp. Let me understand what you want, and then we'll be able to develop a custom plan for you to see how I can support you, maybe in 2 or 3 sessions, to be able to level up. Having said that, here are the 10 steps which you need to consider when you are reviewing your stock portfolio. And the very first step is for you to review if your investment goals still hold based on the current constitution of the portfolio. And I'm saying so because chances are you did maybe invest because of long-term growth. Maybe you did invest because of retirement, right? There are a myriad of reasons. So you need to do stock taking and understand, has your investment goal changed? Is it the same goal? Do the existing stocks in your portfolio serve your investing goal? In case they don't serve, chances are you might need to tweak your portfolio to ensure there is better alignment with your investing goal. And to give you an example, in case, for example, you did buy stocks maybe a few years back, you haven't reviewed, you are approaching retirement, right? And still in your portfolio, the largest chunk of the constitution is growth stocks, which of course are extremely volatile when it comes to the price in the stock market, but then they have a potential upside when time passes. But also the same way, remember, they are very volatile, meaning they can also depreciate. In case your goal was retirement, maybe that might be a cue for you to go hard on dividend stocks as opposed to continuing to insist to hold growth stocks. That's just an example of how you can map your stocks to specific investment goal. And then the second step which you need to follow is that you need to review each company's business. In your portfolio, you have stocks from different companies. So do a deep dive, understand each of those companies' business, right? And I'm talking about you understanding the revenue trend, understanding the profit trend, understanding debts the company has, and even beyond that, try and understand the competitive advantage of each company. Has it, for example, gained market share? Has it reduced? And in case it's gained or reduced, what does it mean to the health of your specific stocks in the portfolio? All this information is most likely going to assist you know which stocks you're going to maintain, which ones you are going to drop. Because case in point, in case a company you invested in was a monopoly at the point of you investing, and then it's lost its competitive advantage, maybe there are more and more entrants into the market, therefore diluting their market share, and also their stock is being depreciating because of that. Maybe that's a cue for you to maybe reduce that particular company's constitution in the portfolio, or even think about total replacement, depending on your investment goal, of course, while you are also simultaneously reviewing the business of the individual companies which are constituting your stocks in your portfolio. And then the third thing you need to do is you are supposed to analyze the company's latest financial statements. And the beautiful thing is that in whichever jurisdiction you are out there, most likely the laws of your country require companies to publish their financial statement. In Kenya specifically, the Companies Act does require directors of the company to ensure that their financial statements are published. And that is why the companies which are publicly listed at the Nairobi Securities Exchange annually do publish their financial statements, right? And even when, for example, they are estimating they're going to have a loss, they do provide just to ensure that the clients out there know this is a profit warning about the incomes reducing. When we're talking about you reviewing the financial statements, we are basically referring to three statements, right? The income statement, which is going to tell you if the company is increasing its revenue, if it's profitable or not, what the company's expenses are, and so forth. The second statement is the balance sheet or the statement of financial position, which is going to tell you the state of the company when it comes to its assets and also its debt levels, right? And then the third statement is the cash flow statement. The cash flow statement is going to tell you if the business is generating cash from its regular operations. Because if it isn't, then it is a big problem. How is it going to continue performing very well in case it is not generating cash from its core operations? So you reviewing these financial statements is going to assist you wrap your head around the fundamentals if the company is in good health based on the latest financial statements. And the beautiful thing about the financial statement is that typically in Kenya, already you have a comparison because they're going to publish the current period under review and the immediate previous period. Therefore, you can start seeing the trend even as you are just perusing through the financial statements. In case you want a deep dive to this, I made a video, a very comprehensive video on how to review financial statements. I've attached the link up here. You can go and check that video for you to really understand how you can deeply review all these statements I've spoken about. And then the fourth thing which you are supposed to do is for you to analyze and understand if the stock is still fairly priced. And I'm saying so because in case you continue holding for the longest, stock which is overpriced in the market, chances are over time, due to price correction, that particular stock is going to come down in price once its intrinsic value reflects in the market. That is why you need to utilize key metrics out there like the PE ratio, price earnings ratio, for you to be able to understand if a particular stock is overpriced or not. And I'm saying so because typically in the market prices are driven by investor sentiments. Therefore, making decisions based on the emotions they have. That is why you reviewing each of the constituting stocks in your portfolio to understand if they are fairly priced is going to assist you know if you need to drop some of the stocks or you need to continue holding them. In case, for example, they are undervalued, right? It's going to mean that maybe over time, their true or intrinsic value is going to reflect. Therefore, the price is going to ramp up. In case they are overvalued, then it means after some time, most likely the price is going to come down tumbling because the intrinsic value is going to really be reflected in the stock prices, okay? And then the fifth thing you're supposed to do is for you to analyze the dividend performance of your individual stocks. What do I mean? Out here, companies do pay investors, of course not all of them, because it is at the discretion of the company's board, right? But they do pay dividends to investors each and every year. So an area of interest for you when you are analyzing dividends, because I strongly believe regardless of the age you are in, the type of investor you are looking for two things when investing in the stock market. Share price appreciation, simply put, the price of the stocks you have invested in increasing. And the second thing, dividends, whereby the company can pay you dividends as a form of cash reward for you being part owner of the company each and every year. So you're looking at the metrics around dividends is going to assist you know how the company has been performing and even guess if it's going to continue paying dividends going into the future. Which metrics do you look at? The first metrics is dividend yield, right? Of course, I've already ascertained did the companies pay dividend or not within your stock portfolio. Then you need to look at the dividend yield. Simply put, they pay dividend at what rate, okay? Because the companies do declare dividend at given amount per share. So you computing that amount which was declared per share, right? And then based on the share price at the point of declaration, what is the dividend yield? If for example, the dividend yield is 10%, it might mean the company is doing very well when it comes to them also allocating some aspect of their profit to shareholders. And talking about the company doing well, the second thing you also need to look at is the dividend payout ratio. Simply put, what proportion of the company's earnings are they committing to reward shareholders with? Remember, you as a shareholder, you are part owner of the company, right? So any healthy company out there, more so a mature company, ideally should be sharing part of their earnings with shareholders. Of course, we understand companies might need to invest in expansion, ensuring operations are continuing to run. But then again, they also should be sharing their earnings with shareholders. That rate or proportion of the earnings against the total earnings which they got that are allocated to shareholders is going to tell us what the dividend payout is. And from that, we can easily tell, is this something within the range which is healthy? Is it unsustainable? Is it unrealistic? Case in point, if a company's dividend payout is over 100%, what does it mean? Where are they getting the money to pay shareholders more than what they got through the earnings for the year? In case, for example, it is under 10%, what does it mean? In case it's a mature company and it is paying, for example, less than 10% when it comes to the dividend payout, what does it mean exactly? Okay? That metrics is also going to assist you shape your head around how a company is working to increase shareholders' value and share in their profits with shareholders, right? Then based on that, you can decide how you can juggle also your stocks within your portfolio. Maybe you want stocks that are paying dividends. You might want to get more of those. Maybe you are okay with growth stocks which are paying little amount of dividends. Based on your financial goal, you can decide how to utilize this information to inform the constituents of your portfolio. And then the sixth thing which you need to look at is you assessing your portfolio diversification. Simply put, are you spreading out the risk when it comes to the stocks you are holding? Or are you having very high risk when it comes to the stocks which you are holding in your portfolio? The rationale behind building a portfolio is that you are able to minimize risk while you are also preserving your capital, and at the end, you could possibly gain. So in case, for example, most of your stocks in your portfolio are stocks from one sector, that might tell you your portfolio constitution is unhealthy because it isn't optimally diversified. Or even so, in case after some time, one stock becomes very dominant in your portfolio, that is also a risk because it's going to mean your portfolio is not balanced. What if that dominant stock in your portfolio ends up not performing well? It's going to mean it will in aggregate pull down the average return of your portfolio. So these are some of the things you're going to need to look at for you to be able to know how to balance your portfolio to ensure you diversify very well when it comes to the weight of the different stocks, and also you are diversifying very well based on industries or sectors, and also based on company sizes. Okay? And then the seventh step or thing which you need to do is you comparing the performance of your portfolio constitutes against the market. What do I mean? Of course, when you're doing technical and fundamental analysis, you're going to understand how each of the stocks is performing individually. The different metrics out there, maybe different ratios, you name it. But then again, based on specific sectors or industries, there are what we call best practices. Simply put, if the best practice, for example, of your industry is that there is good earnings per share, which is consecutively increasing year in, year out. In case a stock which you are holding, which belongs to a particular industry, is showing a downward trend when it comes to earnings per share, then it might mean there's something which is off, right? So all these matrices, you need to compare very well with what the market ideal is for you to really know, beyond just the individual performances, how are they comparing with the sector or industry. And then the eighth thing you need to do is you need to assess portfolio risk. What do I mean? Just beyond the exciting metrics we've been speaking about, you need to also look at your portfolio based on the stocks you are holding. What risks exist? And some of the two risks, for example, which are normally pronounced, which you need to look to be very keen on and ensure you look stock by stock basis, is look at debt, okay, and also look at regulatory environment. Guys, companies out here can be performing very well, but also simultaneously they might be having very high debt. In case you don't do your own research to understand the income the company is getting or the profit the company is getting, is it able to pay the interest and the periodic requirements which are required to pay based on the debts they are taking? In case, for example, their annual requirement to pay an existing debt exceeds what their income is, then the big question is, how will that particular company be able to cater for its debt, right? It's going to mean that also in future, it might struggle. Or even so, in case the debt is growing at a higher rate compared to the growth of the income, what does it mean exactly? Okay. The other thing also, when it comes to the regulatory environment, based on the last time you looked at the portfolio objectively, has the regulatory environment changed? Case in point, have there been implemented laws which are unfavorable to the particular stock you are holding? Is that particular stock, for example, having the company back in that particular stock having legal troubles? All these things you need to look at them because there are possible risks which could end up impacting your portfolio. And based on you weighing these risks, you might decide to attenuate your portfolio to ensure you are minimizing risks. Case in point, a company might be having good indicators, but then again, in case it is having a big and increasing debt, it is having maybe ongoing court cases, that might be a signal for you to even maybe change that particular stock because you know very well there is an imminent risk, which in case the risk is more pronounced, is going to end up affecting the price of the stock which you are holding. And then the ninth thing which you need to do is now you deciding based on all these things I've shared with you. Of course, individually you could decide based on an individual thing, but sometimes you need to decide in aggregate, right? Based on all these factors, there are things which you can accommodate, others you can't accommodate. At the center of it is your investment thesis still holding? In case there's a change on your investment goal, it means you need to do substantial changes to your portfolio. If not, you need to just ensure that you are continuing to hold stocks of quality companies. And quality is defined by all these things I've spoken about. Based on your risk appetite, you'll be able to know which of those things are key that you need to implement immediately. Simply put, they're going to inform the stocks that you're going to release by selling them, and also they're going to inform maybe new entrants to your portfolio or even rebalancing to ensure you are maintaining a healthy portfolio, okay? And then the 10th point or step which most people out there ignore is that you need to have schedule of when you're going to next review your portfolio. And I'm saying so because out here investors, unfortunately, do review portfolios by accident. You find maybe someone considered a portfolio 5 years ago. They've never reviewed. They wake up one day, maybe 4.5 years later, they're like, I want to review. Then again, they go mute for 10 years. Guys, at least once a year, be reviewing your portfolio to really understand, is it still aligning with your investment thesis or the goals have changed? And what I've talked about in this video, all these steps, you can think about utilizing them for you to be able to determine the health of your portfolio. Have, for example, a standing date each and every year. Maybe you can say every mid-year, 30th of June, that's when I review my portfolio extensively. Maybe twice a year, that's when I review my portfolio extensively. That standing cadence is going to assist you, first of all, have the discipline for you to be able to objectively look at your portfolio. And secondly, it's going to assist you manage your emotions because you won't be driven by short-term movements in the market. Rather, you're going to have your eyes on the long-term picture because you have a standing cadence for when you're going to be reviewing your investment portfolio. Guys, what do you think about this video? I hope you got a thing or two which you're going to implement for you to be able to ensure you are maintaining quality investment at all time and your portfolio is in good health. Cheers, guys. Looking forward to catch up with you in the next video.